Well, I briefly outlined the kind of market activity that we saw play out in yesterday's session. What are you making of that kind of activity we're seeing at this stage?
First of all, yeah, it's true. We've noticed a slowdown in market activity, at least for the last 2 weeks. The market is currently down about 100 points since the last 2 weeks, and I think this is just as the market goes into the festive season, it's kind of expected that people start selling here and there, and I think that's what's really contributing to the to the downward pressure that is pulling down the market basically. So I guess going forward we're likely to see the same activity repeating itself all the way down. I mean all the way in the next about 2 weeks. Where we expect the market to kind of bottom out before we see an upward drive.
For now, we've got pressure still being exerted by Kenya Airways, and that company continuing to make headlines. We've seen the company agree that it's going to be reinstating retrenched workers, but at the same time, those workers rejecting the offer that's actually being put on the table. What's your assessment of what's playing out when it comes to those negotiation sessions?
First of all, I'd like to say that the whole thing is really messy, and I think the market has taken note of what is happening, and it's really punished the stock. Actually, since that announcement came out on Monday this week, the stock is about 2.5% down. And I think as these negotiations and the the pull back and forth between between the company and its employees continues, then we don't think that that particular stock is going to fare well in that kind of an environment. So one thing that also comes out is the fact that these are costs, employee costs that the company was seeking to save, almost about $12 million on an annual basis. Now these are costs that has come back on its books again. So the plan that the firm has to to turn around turn around and go into profitability again, it now suffers a setback. So I think it's going to be an interesting environment going forward, and see how these two sides kind of negotiate and see how it can really normalize operations for that particular firm.
Of course, the company's already issued a profit warning for the full year. We've seen it move into a pre-tax loss over the half-year period. What, as an investor, would you like to hear from the company at this stage?
Yeah, it's true. Announced about $60 million loss, and expect at least the full year results to come less than 25%. I think what the market really wants to look at is more than just what is happening right now. They really want to see how is the company going to put a lid on its operational costs, because it's not just only staff costs that is affecting its profitability. There are also costs like fuel that accounts for about 40%. So the market really wants to look at how it's going to handle its fuel hedging going forward. And another thing as well is look at it, how is it going to cut down on some of its loss-making destinations, and increasing frequencies on its profit-making destinations. So I guess the market is really likely to focus on those two areas going forward.
Well, we've got Kenya Airways dominating and really stealing the news headlines in the Kenyan markets. Kenyan set to close its books tomorrow, and on the back of that, many expecting a lot of activity surrounding the counter both today and tomorrow. Rufus, what's your sentiment around Kenyan?
I think we're likely to see a bit of activity. Possibly speculators bidding up in anticipation of a dividend announcement. The company has really done well. It's up about 10% year to date, and I think with the plans that they've set out to do for next year, we think the company is really on a highway to increase its profitability. So I guess I expect to see a bit of optimism feeding into that stock today and tomorrow before the announcement comes out.
That optimism seems to be taking Everready to new heights as well. Yesterday, that counted the highest gainer on the NSE, and many attributing it to the fact that we've seen a pretty stable currency. Run us through that story and just what kind of investment case Everready is putting on the table for you.
Well, first of all, we're still very bearish in that particular stock, simply because they have not really followed through on the plans that they've set out. They came out, I think, in the month of May, and they say that they're going to establish a subsidiary to help them diversify their business, because as things stand right now, they get 80% of their business from selling batteries. And I think, looking at the last 5 years, their sales on that particular segment have, been dipping ever since, and as well as that has also affected its profitability. So I guess the market was really hopeful when they came out of that statement, but until this point, we've not seen any tangible movement in that particular direction. So I guess the market is really is punishing them for that particular delay. But I think the plans, just looking at them, I think they're very hopeful for that particular company, because as we see, diversifying into real estate through this subsidiary, and as you know, real estate is one of the, where the action is happening for this particular side of the continent. I think that will help them to increase their profitability. This particular, we've also seen, zinc prices, which is the biggest cost in battery manufacturing, and they've come down to about 4.5% to trading about $1,900 per metric ton. So I think when you look at it from a fundamental point of view, I think they're going to have a bit of a soft landing this particular year. But from a trading point of view, I think that stocks, from an investor point of view, I think the market is really saying that they need to see more in terms of making good some of their plans that they have going forward. Unless that happens, then we're seeing the stock still trading at the lows of 1.75 or 1.8 for the next whatever time to come.
Rufus, just how much hope are you holding out for a player like Kenya Re? I mean, the counter seems to be struggling, and that following a new guideline that was issued by the IRA earlier on, that in order to terminate insurance, and that possibly putting this company on a back foot moving forward.
Well, yes, the regulator, insurance regulatory authority came out, I think about 1.5 months ago, and said one of the guidelines that they like to see established next month, which is January, is that they expect for every insurance firm to terminate an insurance contract. To terminate its reinsurance contract, then it has to seek an approval from an in-house actuary. Now, the challenge is this: there are not enough qualified actuaries in the country. With the 45 insurance firms in the market, there are less than 45 people, which means that in Kenya Re as a company, trying to get business from an insurance firm is going to take a long while, and perhaps it's going to even be a costly affair. So I guess these are some of the things that the market is looking at and saying, well, let's just wait a bit and see how this thing plays out. But as of course, they're still lobbying to see that guideline is pushed forward, and to give room for more negotiations. But as things stand right now, I think it's causing a bit of confusion in the market.
Rufus, it's certainly a company that's not sitting on its laurels, though. I mean, they've hired an Australian company to get their product out there, of course, where we know that penetration levels are sitting pretty low. What do you make of the kind of stride they're making in that regard, and actually putting themselves out there in order to gain market share?
What we've seen the companies set out in its plans to do is they want to get into the emerging oil and mineral industry. As you quite know that there's been a lot of interest, oil discoveries in the northern part of the country. So I guess the company really wants to strategically position itself to to come and provide its services for that particular segment. And what they've done is they've contracted a company from Australia to come and train its staff so that they can be able to offer those services. But I think going forward, well, first of all, that the market is interpreting that to be really a good move. But what we're seeing is this increasing competition for insurance services in the country. About 2 months ago, a new entrant came into the market by the name of Continental Reinsurance, and I think going forward is going to be very interesting to see how Kenya Re stands to protect its market share. And from all these from the new competition that is coming in.